So for those of you who follow the channel or may be new to the channel, this video is intentionally being released roughly 2 weeks from the Fed's FOMC meeting in June 2023. We're going over this a little delayed intentionally to digest what the Federal Reserve put out there, Jerome Powell put out there in the meeting, and to see if there was any additional data or considerations to take in before we gave an analysis. So this is very intentional. So we're going to cover what the FOMC meeting entailed. We're going to cover what the Federal Reserve chose to do, what indications it's giving for the future and its outlook on the future, how it ties to your money, your finances, your borrowing capacity, your deposits, and your acquisition of real estate, whether that's primary residence or investment properties. We're going to cover as much of that as we can in a relatively short video. So the Federal Reserve made a decision in its FOMC meeting in June, I believe 13th or 14th, to pause, as many had indicated in the market and other analysts had suspected them to do. But the Federal Reserve paused what many are calling hawkishly. And I put air quotes on that for those of you who may not be watching them, but you're listening. And what that basically means is the Federal Reserve has made it abundantly clear that they felt the need to monitor the speed at which they tackled inflation when they finally started to, by doing it incrementally fast, and then descending down as they're getting closer to their target goal and getting more focused on consuming data and trying their best basically to balance getting inflation under control in a timely manner without damaging the economy too severely. So Jerome Powell emphasized, we are looking to balance off, taper off the speed and velocity at which we're hiking rates, but strong indications that he's not done hiking rates. The Federal Reserve has made it abundantly clear they have no intentions on cutting in 2023. It's out of the question. On top of that, the Federal Reserve, Jerome Powell in particular, indicated we are likely just skipping, his own words, which he tried to correct and clean up after the fact. He wasn't very successful. And he used the word skip in the FOMC meeting when asked by a reporter about the current pause decision. And he made it clear, look, we want to be very cautious about the velocity and the speed at which we are raising rates and making these decisions as we're getting closer to our target goal, because they don't want to over tighten. So as they're coming in to their landing strip, if you will, they're obviously doing like any plane would do and putting the brakes on. Now that having been said, they have made it clear they are not at stop. Federal Reserve is actually doing what many thought was going to be over at this pause point that they took. The Federal Reserve is actually going beyond that and making it clear there's highly likely a couple rate hikes baked in to the rest of 2023. That's powerful news, very powerful news. The Federal Reserve also gave its 2-year indication projections on where interest rates will likely be in 2023, 2024, 2025. The Federal Reserve expects interest rates, or is guessing that interest rates could be up to somewhere around 5.75 by end of year this year, which is pretty powerful, meaning we could have another couple quarter basis point hikes coming in the next couple meetings coming up for the FOMC. Jerome Powell also indicated that July could be a live, air quote live, July could be a live meaning we could be ready to fire again on increasing interest rates in July. 2024 projections have gone from 4.3 to 4.6 basis points interest rates for the end of 2024. That means that they were originally projecting to be somewhere around 4.3 by the end of 2024, meaning that they would be cutting rates and they would be somewhere down to 4.3. They've upped that to 4.6. Subsequently, they've also done the same for 2025, going from 3.1 to 3.4. So 3 basis points up, or 30 basis points up, excuse me. I don't know why I'm fumbling through that. So the Federal Reserve is highly indecisive on where things are going to go, as far as it goes with how far and how long and how deep they're going to have to raise rates. They are not sure. They're uncertain. And this is really interesting news for the overall economy, the job market, real estate, funding, to lending. It's just a big deal across the board. Speaking of the labor market, the Federal Reserve has indicated that this pause was hawkish, essentially, and that we're likely looking at further rate hikes because core inflation, not headline inflation, which is down to about 4%, but core inflation, which is still hovering around 5%, is sticky and very stubborn. It has not budged very much in the last handful of months, even with the pressure the Federal Reserve has been putting down. And the Federal Reserve, as I've mentioned in other videos, is desperately trying to get this to start moving down at a reasonable pace because they want to do this while the economy can afford and sustain these rate hikes. They are not trying to crash the economy. That's not the goal. They want to cool it off, not ice it. And if they can't get core inflation to drive down significantly enough, then they're going to have to get more aggressive, which puts more pressure on the economy. And that's really what they're trying to balance in this situation. The labor market has, by his own admission, Jerome Powell, been astonishingly resilient. The overall economy has been astonishingly resilient, meaning that they are really shocked at how well the economy is absorbing the rate hikes so far. And the labor market is staying really tight so far. We're still under 4% in the labor market, meaning that we're almost at full employment. And record lows, not just a few months ago, at about 3.2, 3.3, we're maybe up to around 3.7 currently, which again is still extremely low, meaning that things are hot in the labor market. And that is still creating a scenario, or what they consider a wage price spiral, where more people are getting jobs, getting paid higher wages because the job market is competitive, and that money's still flowing out in the economy. And people are spending a lot of money when it comes to experiences now more than things. So traveling is hot, and going out to eat at restaurants, these actual live experiences are really where the money is at in the, hospitality and the various sectors where leisure spending is up. So with this being the case, the Federal Reserve is really being, pushed on its heels at the stubbornness of inflation, core inflation, and the overall resilience of the economy so far from the interest rate hikes. Now, mind you, quick caveat, it takes around 12 plus months for the interest rate hikes to really ripple into the economy. So if that's the case, roughly, we're actually just starting to get into an economy that's feeling some of the first rate hikes from 2022. And the major ones that went into the end of 2022 and early 2023, we have not really fully tasted yet. So keep that in mind. Now, what does this tie into you guys' financial picture? Because I can obviously dive on this data and this FOMC meeting quite a bit. I don't want this video to be too drastically long. For you guys, we're going to quickly cover a couple sectors. Number one, interest rate. Even though there was a pause in this meeting, interest rates across the lending markets are going to stay roughly where they are and continue to trickle up, especially with the Federal Reserve indicating they're not done hiking. So the mortgage market, credit card rates, any variable rates on your loans and lines, auto loan rates, all of that's going to stay flat or go or trickle upwards. It might trickle down here and there for a second, but I promise you it's not going to stay, especially if the Federal Reserve does increase interest rates again coming up in the next meeting. Deposit rates are going to do the same thing. They're going to either flatten or they're going to continue to increase because, yet again, Federal Reserve has made it clear that, yeah, we're pausing now, but things are still hot and we still have a lot of work to do. And banks are going to keep forecasting that. And if they have to continue to increase their lending rates, they know that they also have to get their deposit rates to keep up as well. So you can expect CDs, high yield savings accounts, to stay relatively flat or grow in the next month or two. Again, especially if the Fed raises rates. The real estate market is probably one of the biggest stories I personally think to cover, the residential market in particular, because what I've been screaming from the rooftops is that real estate is going to be a time bomb again because there's not any significant signs of our inventory crisis being resolved. The government is working pretty hard to avoid any major wave or cascading foreclosure. The commercial transitional market, where all of these office buildings and places that are now vacant from a ghosting commercial real estate market, trying to convert those into those, like, go from commercial to multifamily residential is a hard transition, especially in this economic and interest rate environment, to pull off at a large enough scale to make up for 3, 4, 5, or 6 million, housing units short. Those are 2 out of the way. Number 3 is just new build construction. And though it seems like a slight improvement in that arena, it's still overall slow versus what we need in order to deal with our housing crisis. Those are the 3 major areas you can expect inventory to be popping up. The resale market is not budging because interest rates are still too high. So people are not moving out of their starter homes into their second homes or graduating up because they're locked into these low interest rates and they can't afford or are not interested in the ones that are out, the interest rates that are out there now. So with that being the case, inventory is not solved. And when interest rates trickle down enough, then that means that we are going to experience significant single to double digit growth in real estate all over again, because people are going to fall off the sidelines and now be psychologically programmed to upper 6 and 7% interest rates. So getting down below 6 alone can create a feeding frenzy across the United States again on residential real estate. I've said that's a time bomb because that means people who own real estate at the time of that transition are going to see massive equity gains again. And even though interest rates are going to make homes more affordable, prices are going to go right back up and compensate for a lot of those interest rate drops we're seeing. So I've been arguing for a while now, and I'm going to continue to do so until I see data saying otherwise, that it's time to get into residential real estate. Single family, 2 to 4 unit real estate is going to be a big deal in the coming 2 to 3 years. Now, what the Federal Reserve is doing with these interest rate hikes that we look like we may get the rest of this year is pushing that clock back. What they're doing now is basically saying interest rates are going to stay up longer. And if that's the case, then that means that you may have more time to get into your primary or investment properties on the residential side. And what I mean by that is if you can afford it, because prices are going to still kind of trickle down in some to many markets. It's still competitive in some markets, don't get me wrong. But there are many markets across the United States that are seeing price declines and homes sit on the market for 3, 4, 5, 6, and 7 months at a time. So it's getting to the point where the pricing is trying to trickle in a direction to match these high interest rates. But honestly, it's nowhere near what many people would have thought if you'd have told them this a year and a half ago. So it could be an opportunity still for you to get into real estate in the next 6, 9, 12 months, depending on how far out the Federal Reserve's rate hikes go and how long they stay. Now, this is all going to be pending inflation, And obviously, the Federal Reserve's Fed's fund rate is not a direct correlation to mortgage rates. They can start to drop with the Fed's fund rate going up or staying flat. Keep that in mind. Inflation dropping, the 10-year treasury dropping, those things going down are a little bit more correlated to mortgage rates than the Fed's fund rate is. So you could see the interest rates change in the mortgage market regardless of the Fed's fund rate or the Fed fund rate hikes. But at 9 out of 10 times, it's probably going to stick pretty close for a while, meaning that you need to continue to position yourself to get in or expand your existing residential real estate holdings. This is going to be a big deal and a big opportunity at some point in the next couple to few years. Interest rates will come down and inventory will still be relatively tight compared to the buyers out there available, and housing prices will respond accordingly. So get in position now, get the deals if they're available now, even if it hurts some. Because 9 out of 10 times, unless there's a massive wave of opening in inventory, prices will go up in the next 1 to 2 years. And many of us who are not there yet are going to wish we were inside of either a great primary residence, at least, and ideally a few rental properties if you don't already have some. Get in quality areas where appreciation is likely, B-class, A-class neighborhoods, C-plus neighborhoods, and just sit. Even if the rates are high, you can refinance later. Just sit. So I know this was valuable information to you guys. I'm grateful for all my pioneers for tuning back in. To all my new viewers, welcome in. Like the video, subscribe. I want to keep this conversation going in the comments. Legitimacy, comment down below and let me know what you think about all of the information in this video. What do you think rates are going? What do you think the economy is going? When do you think a recession is likely to kick in? What does this mean for borrowing, for your personal finances, for your business funding? What does this mean for owning real estate? Do you think I'm right about the real estate market? Do you think things are going to blow up? Do you think things are going to crash? Do you think I'm wrong and I'm missing something? I want you to comment those conversations and thoughts in the comment section below. Also, there are great links to some great lenders because there's some amazing credit card offers out there through the lenders I have in the description. I have Chase Bank, Amex, Capital One, some of the biggest and best lenders out there. Great welcome offers if you use my referral links to support the channel and get yourself some great welcome bonuses with some great lenders who, by the way, are still actively lending in this market. This could be a great time to get new personal or business credit cards for some solid lenders and support a great channel that's supporting you at the same time. Other than that, I appreciate y'all tuning in. To all my pioneers out there, I want y'all to stay focused, stay in motion. I'll see y'all soon. This is JP from Blueprint for Prosperity Network, a channel dedicated to helping you increase your net worth through relationship banking, maximizing your borrowing capacity, the proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity.